What's going on, investors? AK from Fallible here. Today I wanted to share a portion of an interview I did with my partner in macro ops, Tyler. In this segment we talk all about how I started investing in growth stocks. So we go over the process from initially finding the trade with screens of fundamentals and technicals, and we also talk about entries, risk points, position sizes, and all that good stuff. This is a great video to watch, especially if you're a beginner trader. So I'm gonna play the interview now, and if you learned something, make sure you subscribe to this channel and hit that bell for notifications of new videos. Because this is only one part of our total video, so be on the lookout for future segments.
I guess after you got into trading, and what did you start to focus on? Were you mainly equity based like your dad? Was that what you gravitated towards, or what did you really dive into and find a passion for?
Yeah, my favorite was definitely, and what I started with was growth stocks.
Okay.
Investing.
Mm-hmm.
And then over time, I got sucked into macro because that's so interesting to me. You know, anyone starts reading macro, they're going to get sucked in. But so I got into macro for a few years, and now I'm kind of going back to just simple momentum stocks once again.
Mm-hmm. Yeah, macro is definitely, it's a lot more interesting because you get the political views kind of mixed in there, the newsy type stuff, big current events that everyone's talking about that impact the macro landscape. So
makes you feel so smart too. Makes you feel like a real billionaire hedge fund manager.
Oh yeah, if you can whip out monetary policy stuff at some conversation. Yeah,
so smart.
So if we go back to your framework you're using now, you said you're using momentum stocks. I want to kind of dive into that a little bit deeper and sort of suss out your process. So how do you go about searching for trades? What's the first step? So you don't, let's say that you took a vacation for a year and you're coming back and you really have no idea what's going on in the market. What's your first step?
Well, what I used to do was basically look at what's been moving.
Okay.
Like, I would have screens that do that for me. And this is the manual process that I used to do. So I'd have the screens that would spit out potential movers. And then once I had a list of names based off technical criteria, I would look into the fundamentals.
Okay.
Like,
so what were these screens spitting out? Were they mainly technical things like, oh, this stock went up 20% in the last year, or what was the screen mainly screening for?
Even back then, it was just simple patterns. I could put a screen together that will give me a number of stocks that are forming bases that have been in an uptrend for an amount of time and are now consolidating, giving you a chance to enter.
Okay, and so you're basically mathematically defining, or you're coming up with some quant definition for a trend and then a basing pattern.
Right.
Okay, and so that was
real simple. Like you can easily do something with 50-day new highs, you know, just to find those types of stocks, and then you want to go through them and make sure they're basing.
Okay, so you would get this scan, and then you would go there and you would give them a visual look, a quick look with your own eye to further filter them. Okay, and then you said you'd go into the fundamentals. So when you kind of were digging down into the fundamentals, what are you specifically looking for?
I try to keep it pretty broad, where I'd be looking for revenue growth at a certain level, say double-digit revenue growth, and then I want to see that show up in the earnings growth too. Because you know, for any growth stock, you don't want to see growth coming from just cutting costs.
Yeah.
The actual business growing.
Yep.
I used to look at margins and dig into deeper, like what's happening with the story, what new product they have. But honestly, if you're using Occam's razor and you're really cutting down to what's most important, then when you see revenue and earnings growth and you see a trend and a setup, most of the time, you know, you're in good shape.
Okay. So yeah, you're really focusing on just revenue, earnings, really the two most important key indicators, and you're not getting.
Yeah. I think if those two are trending in the right direction, then there's a lot of correct stuff happening, you know, in most cases.
Stuff's usually going well. Okay, so I guess you something spits out of a screen, and then you look at the chart, and then you're looking down into the fundamentals, and then by this point you're basically whittling down what you actually want to purchase, right?
Right.
Okay, so let's say that you get something that it passes all of your criteria, and you're actually looking to purchase. Then what? You know, how are you entering? How many shares are you buying? What does the entry look like?
What I used to do was breakouts, but those don't work as well. So I'm just looking for a potential breakout or just an area where you can define your risk pretty tightly, where you know if it breaks this point that you shouldn't be in it anymore.
Okay. So you're looking for some type of chart inflection point to where you enter it. It's pretty easy to identify when the setup or the play is going to fail, and that failure point's fairly close to your entry. So when it does fail, you're not taking a massive loss. So what I used to screw up on was making it too specific. Like, oh, this is a cup with handle, so it has to break this by this percent, cross this line. And it's stupid. The way you look at a chart, it needs to be more general, right? So like you said, inflection point. Like if it breaks this point
and there's a fundamental change, then you know you shouldn't be in it. But if it's going to follow the trend, then it should break this horizontal, just in general, long consolidation and keep going. And that's where you want to be getting in.
Yeah, I think definitely over the years, at least for me, I've taken a much more general approach to charts. You know, when you're starting out, you tend to think that every little tiny pattern matters, and you realize as you go that no, it's more general trend versus consolidation. You know, the slope of the stock versus the exact little cup and handle definition. So yeah, that makes sense. So when you're entering this, you get in and then you're setting a stop, basically a price level on the chart where you're just getting out no matter what if it hits it.
Yeah. I mean, I wait for a close. If it closes below, so you don't get shaken out. And those stops, you want to keep them somewhat wide.
So do you have how
much short-term noise there is now?
How wide is a stop typically for you? Is it 2%, 10%, 20%? Like what's the ballpark area for your stop size?
Depends really on the chart formation and where I'm able to get in. So for me, I mean, the best entries, like a tighter stop in the sense that it's a strong support level is what I would like, because if it breaks that, then that is truly the inflection point. But sometimes you can't always get that. So it really varies. But the problem is the way I size the positions on a risk basis. So if the stop is too wide, then the position is going to be pretty small.
Yeah, so I want to dig into that a little bit. So you got your entry, let's say you got your stop. It could be 5% below your entry, or depending on the chart pattern. How are you actually deciding how much of your account you're going to lose? Because just if the stock goes down 5%, it doesn't mean you're going to lose 5%, right? Because you're not putting all of your money into one stock, right?
Right. So when you size it based off a risk basis, you're really deciding if it hits this point, then I'll lose how many bips. Okay. So that might be 50 bips, it might be 100 bips, but that's really how you want to be defining your risk.
Okay. And bips is basis points, right? It's 1/100th of a percent.
Exactly. Okay. So how much will you lose from your entry point to that risk point?
Okay. And so how much are you looking to typically bet on a trade? So if it does hit the stop, are you losing 1% of your account? Are you losing, 50 bips? What do you like to lose on a per trade basis?
I've moved it up around 100 bips, I would say.
100 bips? Okay.
Yeah. Because if you go lower than that, your positions get too small. You have too many positions. You need I feel like you need a little more concentration to even make an impact on your portfolio.
Yeah, because one of the things I've been mulling around lately is the need to stay concentrated if you're going to be trading. Because if you have so many positions on, if you have 20 stocks on or 30 stocks, you start really looking like an index again, right? Yeah. Yeah. So that makes a lot of sense to me. And so how many stocks do you typically put on? So if let's say you risk 100 bips per trade, are you trying to look for 5? Are you trying to look for 10 stocks? Like what's a good number that you like to hold?
5 to 10.
Okay.
Probably closer to the 10 level though. I try not to go more than that though.
Yeah. Yeah. Because I think if you do, then you're definitely at risk of looking like an index.
I hope you enjoyed that. And if you're looking for more videos all about markets, then make sure you subscribe to this channel and hit that bell for notifications of future videos. We cover everything from stock market analysis to psychology tips to even trading strategies. So make sure you subscribe, and I'll see you in the next video. Stay fallible out there. Bye.